Again for another update, and today I'd like to discuss one of the biggest myths in monetary, it just in economics in general. One of the biggest mistakes that the whole world seems to make, whether it be people reporting on TV, in financial press and media, whether it be Bitcoiners make this mistake all the time. Gold bugs make this mistake, Austrian economics, Keynesian economics, orthodox economics. Everybody uses this same mantra, which is actually very, very misleading. And that is that governments are printing money and that's going to create inflation. And you're going to hear a lot about this as the recession gets worse and worse and worse. So today I'd like to give a more accurate representation of how the money printing process actually works, and let you know the misguided consequence of people constantly saying that governments are printing and printing and printing, and that's going to cause hyperinflation. There are some underlying correct assumptions in the effect that might happen as a result of governments printing money. But what I'd like to do is help you understand why that's incredibly misleading and misguided and causes people to really, really miss some of the opportunities that our economy can face to fix itself during the next crisis. And also, Raya wrote a book way back, started in 2010, and the last draft was published in 2012, Bank to the Future, Protect Your Future Before Governments Go Bust. I really wanted to dispel some of these myths and help people understand what can happen when governments do go bust, which is looking increasingly more likely, but they're not just going to roll over. So I'm just going to go through some of these myths and also share with you how this $250 trillion of debt that the world has accumulated in this record economic experiment that the world has never seen, and how that can be repaid, and who wins and who loses if that does actually happen. So without further ado, let's just jump straight in. So the first thing is governments very rarely print money. They print coins and cash, the image of loads of printing notes coming through. The reality is that when governments want to access more capital, they borrow it through the bond markets. They don't print it, they borrow it. And so what they would do is they would typically call up the investment bank, and they would have a primary broker, a special breed of investment bank that has the relationship with the government. And the investment bank would structure some new treasuries or bond products or whichever, different types of bonds. And then they would receive a brokerage fee for selling it to pensions, institutional investors. So essentially you are lending the money to the government. The government's not printing the money through your pension, through your insurance contributions, through university endowments, through retail investors buying bonds as part of their savings, and through other banks and other countries lending. So China is one of the largest lender to the United States through the bond markets. But it's a very, very different process to printing money. The fact is as well, the conflict of interest there is that the governments need to go to the investment banks in order to borrow the money. And who regulates that system? Well, the governments can't simply say, I'd like to borrow this amount. It's the central bank that determines whether the government is allowed to borrow or not. And it's the investment bank that determines the supply or the demand for, sorry, not the supply. The central bank determines the supply. The investment bank can give guidance on the supply based upon how many people are willing to lend. And the higher the credit rating issued by a private company like Fitch, Standard & Poor's, those types of companies, then the more likely they are to be able to sell it. And it also determines the cost of borrowing. So governments very rarely print money. They borrow money very frequently. And that is determined by the central bank on the supply side and the investment bank on the demand side. And that is simply pooling together our money, lending it to the government in order to get a yield or return. And you hear lots of things about an inverted yield curve, whereby 10-year loans to the government are paying lower interest rates than 2-year loans to the government, which is a signal that we're in lots of shit in the economy right now. So anyway, that's the first thing to understand, is that governments borrow money and they sell it through an investment bank, through the bond markets. And investment banks, the more that governments borrow, the higher the commission they get for selling these bonds. The Federal Reserve has to actually balance whether this is going to be inflationary or deflationary, adding this new debt, not money that's printed, this debt to the economy. And the government want to borrow as much as they can so that they can perpetuate the fiat-based Ponzi scheme and repay old creditors with new creditors' money, the classic definition of a Ponzi scheme that backs all digital currency that's issued by the banks, by the central banks. Also, the central banks is the one that's determined how much they're allowed to borrow, as said. And at the moment, the world has accumulated approximately $250 trillion of national debt. To help you understand how large $1 trillion is, I saw a great example that I gave on my TEDx talk way back about 7 years ago, I think. If you look up Simon Dixon TEDx, I forget what the video was called, but you'll see some of my presentations. And I gave an example of exactly how much $1 trillion is to help you visualize it. So if you take $1 million and convert it to seconds, it's approximately 12 days. So 1 million seconds is approximately 12 days. I should have checked this before recording, because you can fact check this, but the point will still be the same. Now, if you increase 1 million seconds to 1 billion seconds, that time frame increases from 12 days to 32 years. That's the difference between 1 million and 1 billion. Now, if you take 1 trillion seconds, it goes from 12 days, which is 1 million seconds, to 32 years, which is 1 billion seconds, to 32,000 years before Jesus Christ, if you believe in that, whatever your religion may be. But 32,000 years, you get the point. So 1 trillion is vastly greater than 1 billion. It just helps you visualize. And the US is approximately 24 trillion in debt, and globally 250 trillion of debt exists. So that cannot be repaid. The reason is because there's more debt than money. So it is the classic definition of a Ponzi scheme. And so you, over the years, use financial engineering in order to solve that, kick down the road a little bit further and keep the system alive. So the second thing to understand, so that's the first thing to understand. Governments very rarely print money, they borrow money through the bond markets. Very different process, very different consequence. The second thing to understand is that when you replace one form of money with another form of money, that is non-inflationary. And inflationary is the effect of things getting more and more expensive, and some economies are going through hyperinflation, which completely destroys economies and just grinds economic activity to a halt, is extremely destructive to people's savings and can lead to complete turmoil and unrest with people when you destroy their monetary system. But replacing one form of money with another form of money is not inflationary, because you're not increasing the money supply. And so if you went through a process like I'm about to discuss, there are obviously consequences, but these two assumptions need to be taken into account when we are about to see what moves the governments are going to do next. So another thing to understand, a common, if you believe in different forms of economics, there's a school that really believe in a gold reserve as a regulatory force to control how much fiat money is created. The important thing to understand is that while gold does have a regulating force in terms of how much debt is created and how much money is created, gold reserves typically don't work because the system is a Ponzi scheme. And so when you have a Ponzi scheme, and you back it by gold in order to regulate how much money is actually and debt is actually created, all that happens is that when it comes to the destruction of the system, because there's not enough money to pay off old creditors, rather than taking the pension system and allowing them to go bankrupt, and the socialist system and the welfare system and all the obligations that governments rack up, they will always remove the peg to gold, because the consequences of keeping the peg to gold is destructive in a Ponzi scheme like environment. You'd have to remove the Ponzi scheme before a gold reserve could actually work. And fractional reserve banking and fiat currencies are a classic definition of a Ponzi scheme. Therefore, the gold reserve will always be removed at times of economic disaster, black swan events, and financial crisis. So simply returning to a gold reserve in order to regulate a Ponzi scheme operating off a system where there's more debt than money just always inevitably leads to the inevitable removal of that gold reserve. So that's not a viable solution in my estimations either. So that's the Ponzi schemes thing, some of the common myths that are all being debated right now. The most likely solution that I think is going to happen, and the only way that you could actually pay down this $250 trillion of debt. So we've grown the economy based upon a debt-based system into an economy of, obviously crony capitalism and a higher rich-poor divide than we've ever experienced as a result of who actually benefits from money creation when it's created as debt, but also one of the most prosperous economies. In my book, Bank to the Future, that I wrote so many years ago now, I talked about this debt-based economy that also has created an unparalleled economy of freedom based upon innovation and all sorts of stuff. So, it's created one of the most prosperous decades and decades of innovation. There's different schools of thoughts on that. Some say that if you didn't do it on a debt-based Ponzi scheme, there would have been the same, if not more, innovation. That's a controversial thing for economists to debate. And there's different schools of thoughts as well, including one put forward by Saifedean Ammous in his book, The Bitcoin Standard, which believes that you would have had that it suppresses innovation based upon the debt-based fiat monetary system. But that's a controversial subject and a debate to be had. But the reality is that the national debt cannot be repaid. And what people are spouting on the news, and as this recession gets worse, is that the governments are going to print more and more money in order to meet their obligation, which they're not going to do. They're not going to print more money. They're going to borrow more money to meet their obligations. And that's going to lead to inflation. The reality is that they could, if they chose, completely wipe out the investment bank from that process and actually print their own money. Which is what I think that they're going to do during the next systemic risk event. I believe that all governments around the world are actually in the process and have many of them developed their own central bank, non-debt-based digital currency built upon some kind of blockchain, probably not a public blockchain, probably with no proof of work, but a digital currency. And I've been talking about this for years before governments actually started creating them, that they're going to do this. If you look back through the video archives. And the reason that they're creating that is for two reasons. One, they could use it if they chose to pay down their national debt, non-inflationary. Because if they were to use this new non-debt-based digital currency in order to repay their obligations to pensioners, to foreign currencies, to everybody that's engaged in the bond markets, then it would be just replacing debt-based money with non-debt-based money, because you're using a new digital currency which is created to the value of the national debt, or you could use different models in order to do that. And then you take this non-debt-based money, and as these bonds mature, rather than perpetuating the Ponzi scheme, creating new bonds in order to get new investors to pay off old investors' obligations, they could simply pay it down using this new national this new digital currency, which is essentially a digital representation. But at the moment, what they do for their digital currency is they've outsourced it to the banks, and the banks issue this new digital currency every time they issue a loan. Check out my video, The 6 Forms of Money, if you want to understand a bit more about the different forms of money. But the point is that everybody will tout that this is governments printing money, but what they're actually doing is they're introducing a debt-free money supply and using it to pay down a debt-based money supply. There is also a load of debt in the banking system. And the fact of the matter is that the banks are operating off a Ponzi scheme as well. And so therefore, when people default on their debt, that actually means money disappears from the economy, because banks create money every time they issue a loan, and every time that loan is repaid or defaulted upon, the money disappears and the money supply contracts if it's not a new loan is created in a greater quantity. So if the government decided, or the central bank, if the government decided that they just wanted to create a new money supply, they could use their central bank in order to create it. They could determine the supply based upon the national debt, and they could have an algorithm that says every time a bank goes bust, we can create new money, debt-free, to the value of all the deposits that customers had with that bank. What this would do is it means that you have enough non-inflationary money to pay down the national debt if the government chose, without paying the investment bank the brokerage fee and selling it through the debt capital markets. Now, that might be very scary to many Austrian economists, but the fractional reserve system is, I guess, a free market private money supply created by the private banks that might be more suited to Austrian economists, but they haven't fully looked and tackled this issue of how to distribute the money supply and how you would regulate a fractional reserve banking system, which is why Milton Friedman always said that, you know, making changes at the central bank and changing to a gold standard without changing fractional reserve banking is meaningless. So if the government chose, they could pay down all of these bonds as 2-year bonds, 5-year bonds, 10-year bonds become payable. They could do it with a new digital currency created by either the central bank or the government if they choose. Now, they could also have a choice about what to do with all the excessive consumer debt, mortgages, and everything as the banks go bust. They could do one of two things. They could make fractional reserve banking illegal and require all banks to go to full reserve, but that would send every single bank bankrupt. It would expose that there's not enough insurance deposits to repay all the obligations, and that's another Ponzi scheme that would be exposed. And it would also mean that everybody would lose their deposits, which is a very undesirable situation that would lead to global unrest and take us back centuries into barbarianism, probably. So the reality is you can't let the banks go bust unless you have an alternative. And there's two things that they could do. One, that if they could let the bank go bust, and then the central bank could determine that anybody that has a deposit with that bank can go to the central bank, download their digital wallet, and that would mint new digital currency of the pound or the US dollar or the renminbi or every currency, fiat currency around the world. And you would essentially be replacing money that was backed by debt by letting the bank go bankrupt. Then you would be replacing it with debt-free money, and it would be non-inflationary because you're just replacing one form of money with another form of money. They could also, the second alternative is that if they wanted to keep the bank alive, then as these obligations become available, then they could issue, make fractional reserve banking illegal and issue the bank that digital currency. The challenge with that is it would lead to a huge profit for the bank, but it would be an unwinding process. It's probably less desirable, but there are free market versus governments controlling the banking system or central banks controlling the banking system's alternatives that can be debated out. These different forms actually exist. So in the next financial crisis, they could just replace it. Now, the question is whether they want the private banks to do banking or whether they want the central banks to do banking. Governments might want more control, and so they create a central bank API where fintech companies and banks can build on top of that API key and issue, competing financial services without crony capitalism by having a banking license and the ability to create money that is offered to people that have a fractional reserve banking license. So these opportunities exist, and I think that they're going to be exercised because we're reaching the end of the Ponzi scheme as my forecast, if you've been watching many of my videos. There is a challenge with that. The least fractional reserve and private bank created digital currency is one step removed from the government. Governments actually engaging in banking might actually mean, have big effects on your privacy, and the automation of tax collection and all the issues of the government getting it wrong and then you having to claim it back, and a real effect on if they don't like how you're spending your money, switching off your passport. At least with the banks, they have to try and get a subpoena to try, and then it's one step removed. So there are definitely downsides to debt-free money created by a government. But at least the system would be a lot more transparent, and you could put all this on a blockchain to see the issuance of money, and you would remove all these things like M0, M1, and M4, and all the confusion of how the money supply is that hides some of these issues, that causes all the confusions of people thinking that governments are printing money, and that's going to be inflationary because they're not actually printing money. So we've talked about the bailouts that could happen. The concept of making fractional reserve banking illegal, moving to a non-debt-based system, which wouldn't be a Ponzi scheme, it would have its challenges. But there are new interesting things that could now regulate and make this system more honest. And that is that for the first time in human history, these government currencies would be competing. And so they're not doing crony capitalism by issuing the ability to create money by the private banking sector. They're issuing straight, plain vanilla, debt-free money. But they can compete with fixed money supply, deflationary currencies like Bitcoin, where people could put their savings into something that has a fixed supply and is more and more scarce and has much lower levels of inflation. Whereas if the governments were determining how their money supply would be created rather than through the issuance of bonds, but by paying down the national debt, and by determining whether they want to bail in a bank or bail out a bank, let it go bust, or replace their money supply without depositors losing money. And remember, that's all non-inflationary because it's not new money. You're just replacing one form of money with another. But it would also be competing with, because fractional reserve banking would be illegal, stable coins can come along and they can create their own digital representation of debt-free money. But it's all backed by debt-free money. And you have Facebook would come along, they create their Libra cryptocurrency, and you could have lots and lots of competing systems as a result of this, which would decrease the likelihood of crony capitalism because you don't have to go through this huge hurdle of the regulatory implications of getting a banking license, all because you're given the ability to create money, perpetuate a Ponzi scheme, the fiat-based Ponzi scheme, which creates systemic risk in the financial system, which needs to be highly regulated, and therefore very few banking licenses are actually issued in terms of clearing banks that have access to the central bank. The government could debate it out in terms of how much debt-free money is created to control inflation and deflation. And if you don't trust them, it's done through the process of competing, having choice. So, the economies that do that. And then you are in a genuine economy where governments can create money. And then you're in the system that people think we have. But at that point, you can very clearly see whether they're creating hyperinflation because it's not hidden through the bond markets with the investment bank getting their cut and the Ponzi scheme where all money is backed by debt. And therefore, there's more debt in the economy after the interest than there is actual money. So these are the things that I think are going to actually happen. The central banks can compete with it's just a competition based economy, which I think is what the Austrian economists were actually looking for in the first place. Anybody can create a digital representation of a non-debt based currency. You'd probably have to implement more reforms and laws. You'd have to make fractional reserve banking illegal. You'd probably have to, the reason that the gold reserve actually was removed is because you could use margin in order to issue, more products based upon gold that doesn't actually exist. So you need to have tight regulations of margin and things like that, and probably make it legal so that you don't have things like more Bitcoin through margin trading than there is actual Bitcoin. And so regulations will still serve a purpose, but this is the type of thing that I think we're going to see as the final economic tool. Now that interest rates don't work, monetary policy doesn't work, QE is out of control, and all these things. And then debt can operate in a peer. So personally, I do not have a problem with debt. I just have a problem with money created as debt for facilitating a Ponzi scheme. Debt can still be a useful tool to stimulate business growth and meeting people's obligations, but it's all done on a peer-to-peer basis through peer-to-peer lending, or loans based upon 100% reserve money, whereby you would actually have money in your current account that can't be lent out, and then you would actually give the bank permission to lend your money. And that creates all sorts of interesting scenarios and products, whereby if you're giving the bank the permission to lend your money, you could actually have a product that says, I don't want this to fund any kind of war or any kind of negative effect on the economy, or based upon whatever your ethical or guiding beliefs are. You could dictate the flow of money, and therefore probably money would flow into less harmful things, or if society wants it to, then it would flow into that. But at least people would know what's happening with their money. It would be permission-based, and that could all be administered through blockchain technology and all sorts of innovation that's come as a result of Bitcoin. The important thing is that Bitcoin can regulate the system because there is a fixed money supply, scarce commodity-like digital currency that can be used as a peer-to-peer electronic cash payment system, as well as having a competing force, an exit from the financial system, and giving people choice with their fiat currencies, forcing and regulating governments to make better choices with a more transparent system that's not based on debt and doesn't have a Ponzi scheme built into it. So that's a lot to cover. I did write a book on this subject a long time ago, Bank to the Future, Protect Your Future Before Governments Go Bust. A lot has changed since then. It was the very first published book in the world that included Bitcoin, but also you can check out some of my videos on my YouTube channel, Simon Dixon. Head over to there, put Simon Dixon in YouTube, you can subscribe to the channel. I'll be giving simple updates. This was a complicated one, I do appreciate, but if you follow these regular updates, there's lots of different videos unpacking each of these areas and trying to speak in plain English so that people can understand in an environment of technological and financial jargon that is extremely challenging. But if you want to head over there, hit subscribe, and remember to press the bell channel, the bell symbol, because then YouTube will send you an email every time I go live, or follow me on Twitter at Simon Dixon Twit, and I'll be giving commentary as everything unfolds in the system. So I'm going to get back working with companies building the future of finance. And I've got a big list of videos that I'd like to create, and I'll try and create more of these. So thank you for your time.